click this video because you want generational wealth, not get rich quick wealth, not I got lucky once wealth, generational. Here's the problem. Most investors chase high returns. The next Tesla, the next Nvidia, the next 10x. Like a dog chasing its tail, they go around in circles, while those returns laugh and keep on walking. Legendary investors, the ones that have crushed the market for decades, they don't think like that. They focus on how not to lose money. And when you learn how, you stop chasing returns and they come to you. In this video, I'll show you what investors that chase returns are missing, the 2 big risks you need to protect your money from, and the exact framework legendary investors use, so you can let those returns come to you and build generational wealth for your family. I'm Jack, and 7 years ago I had no idea about stocks. 2,500 hours later, after studying from the world's best stock investors and building frameworks, applying it in the real world, I now help my clients become confident stock investors. Let's get into it. What investors that chase returns are missing? So let's look at the graph. This is our popular risk and return graph, and it's also called the capital market line. And it shows the risk, or the more risk you take, the more return you're going to make. And it's a pretty linear line, or a straight line. But this isn't the full picture. And Howard Marks had a memo from 2006 titled Risk, and he adds something to it. He says, in my opinion, especially in good times, far too many people can be overheard saying, riskier investments provide higher returns. If you want to make more money, the answer is to take more risk. But riskier investments absolutely cannot be counted on to deliver higher returns. Why not? It's simple. If riskier investments reliably produced higher returns, they wouldn't be riskier. So he actually adds something to it. You can see in this one that we call it uncertainty. And so with more risk, there is also more uncertainty about what could happen in the future. Now, let's define a couple of terms here. So for us as individual investors and stock investors thinking long term, our main risk is we don't want to lose our money. The risk is permanent capital loss, or our money. Now, commonly through the rest of the investing world, they refer to it as volatility, which is how much the stock price goes up and down over time. So if a stock price goes up and down a lot, it has high volatility. And if it stays pretty steady, it has low volatility. And that is a vast oversimplification for what risk actually is. So as risk increases, the range of potential outcomes increases. So think about all the different things that could potentially happen. If there's completely low risk, we know exactly what's going to happen. And with more risk, there's so many different things that could potentially happen. Think of it like there's infinite types of things that can happen in the future. That is what happens. The uncertainty of those outcomes increases. There's no sure thing. Otherwise, it wouldn't be riskier. And that's why taking on more risk doesn't always lead to more return. There's no free lunch here. All right, so now we return back to that risk and return graph. And I've added the bounds for that uncertainty around it. And now, what do we think most investors focus on when they're hunting for high returns? And where does that put them? Bingo. So shooting for the moon and putting their cash at risk of going to zero. As you can see, there's plenty of ways that it can go up, but it can also go down to zero. Now, where are these investors who have made billions from investing focusing their efforts? Right here. They focus on low risk adjusted returns. Now, by focusing on risk, they destroy the market average return over the long run. Okay, but how? Well, you don't need to be a genius. Warren Buffett has said that 100 times, and it's common sense stuff that anyone can get their head around. The 2 big risks you need to protect your money from. So there's a couple of big risks that we need to look out for. Different investing strategies control these big risks in different ways, and different controls create different risk profiles. And so what are these risks that I'm talking about? Well, think about it. The oldest adage in investing is buy low, sell high. But we can't time the market. So what do? Well, we always risk paying too much. So when something's overvalued. So the risks are we pay too much or we buy something we don't understand. And they're both of those risks are linked together. So index investors control these risks by dollar cost averaging. So we just don't buy at the top and don't buy just at the bottom. We buy all the time, and then we buy a little bit of everything. So we don't need to understand the individual stocks. We just buy everything, the good, the bad, and the ugly. Now, billionaire investors, they control these risks by using common sense tactics. And I'll use an example from life so it makes complete sense. So common sense investing. So you've got a car and you're going to buy it from the showroom. And when you buy it, the retail price says it's $20,000. Now they sold it to you for $18,000. So you got a $2,000 discount. Yeah. But what is that car going to be worth in 10 years' time? So let's have a think. It's worth what someone is willing to pay for it. So you could choose to hold on to your car indefinitely until you get someone that's willing to pay you what you think it's worth, or you match what the market at that time thinks. So you could be completely delusional and hold on to it thinking that your car is going to be $100,000 when it's a complete piece of junk. So we want to think about how does the buyer value your car? Well, think about it. The buyer wants to understand what he's buying, one of those risks. So he wants to know, did you look after it? What are the running costs? Does it have risks like, is there damage that I haven't seen? Is there something that he hasn't told me? Are there defects? Are there issues? Is it unreliable? It uses oil, it's not going to start. I want to know why they want to sell it to me. So does the actual story make sense? Or is there something they're not telling me? And so you're effectively the owner of the car and the shareholder, as well as the CEO who manages that car. Now, through these interactions, that buyer's sussing you out. And if you start dodging questions, you're not being open and honest, you're not answering things quickly about why you're actually selling. And really, the buyer's trying to make sure you're actually aligned with you. You're not trying to pull the wool over their eyes like a used car salesman. So the big thing is, as a buyer, I want to know, can I trust you? So the buyer is actively trying to reduce their risk by buying something they do understand. Now, what about our second risk? So what happens if they pay too much? You'd get stuck with a car that you can't resell, or you sell at a loss and lose money, or it breaks down and doesn't work completely. So they think about, what is the discount they'd be happy to buy it at? Now think about all these little observations you've made as you're checking out the car and you're looking over and you're having a discussion with the owner. What are all these little risks and little outcomes that could potentially happen? And if the guy hasn't been trustworthy, if you've noticed a lot of odd things with it, there's a lot of risks in it that you don't understand. And so you would ask for a bigger discount. Now, if everything's perfect and you're taking it from a granny that's literally had it been the one owner of the vehicle, and there's nearly no kilometers on it, and everything lines up and it's immaculate, then you've got lower risk and it's almost a new car. You'd ask for a less of a discount. That's all it is. It's intuitive and it makes common sense for people when we have a look at this kind of interaction. But no one does this when it comes to buying stocks, and that's why they lose money. Now let's visualize this and bring it together so it makes sense for investing. We've got risk and price are related. And so as you can see, we've got high risk, low risk, overvalued and undervalued. And we can see that the high risk and overvalued is in red. So that's where we don't want to be. So if we get it for a discount, it's undervalued, and it's low risk, it's in the green. Now the curves are arbitrary, but they just show the trend, okay? So let's add some dollar values to it. And let's say you've reviewed this stock and you've come up with a value of $100 that you think it's worth. So at the far left, we've got 0, and right at the top, we've got 1,000. Now you can see what it means when it says undervalued and overvalued. Now let's add multiples to it. $100, there is no multiples, just multiply by 1. At $50, it's half. And at $10, it's only 1/10 of what it's worth as it goes further and closer down to 0. Now, if it's overvalued, $200 would be 2x. $1,000 would be 10x. So as you can see, there's that strong relationship between something being overvalued, something being high risk. Buying an overvalued stock, say something at 10 times the value of it, can take a decade or more for it to actually recover and catch up to it. So you've just wasted your money. And during that time, you've also lost 90% of your money at that time as well, when it actually comes back down to where it's valued at, when the market corrects. And we just don't know when that'll happen. Now, undervalued stocks, say that are at 1/10 of its value, can bounce back as well and revert back to the mean. Now, just like our car example, let's visualize for what that discount that we want to ask for. In investing, and these billionaire investors, they use the term a margin of safety. And that's what they call that discount. That can be as much or as little of a margin of safety as they want. And it depends on, like we've said, those risks of the business that they're looking at in particular. So if they're very certain and it's a great business and there's not a lot of risks in it, then they'll ask for less of a discount. Now, if it's an absolutely terrible business, if it's the worst thing in the world, but it's valued at an incredibly low price relative to its value, say 1/10 of its price, then they'll use a big margin of safety and it can still be a great investment. So now we know how value relates to risk in stocks so that we don't overpay, and then that reduces our risk of losing money. Yeah, but how do I actually apply this to stocks, Jack? All right, that's exactly what we're going to cover now. Let's go. The exact framework billionaire investors use to protect their money to build generational wealth. So here's the frameworks for what specifically to look for and what to stay away from. Now, by the way, this framework and a heap of others you can download for free should save you a heap of time and save you a ton of money by helping you avoid silly mistakes. Now, they're in the description. And a bonus, if you want to learn with a crew of like-minded investors who are all leveling up together, that's free too. My gift to you guys. Same place. Now, these investors, they want to look for targets that are worth hitting. And so how do they do that? Well, the most successful businesses over decades, there's a few key determinants of their future success, and they have these elements in common. So I've broken them down into different frameworks. So we've got a moat, which Warren Buffett effectively reverts to as having a enduring or very strong competitive advantage. And we want to have a look for what type of moat that is, the evidence. We want to have a look at the adversaries that are working against that company, so its competitors. And then we want to be able to actually test that moat under difficult circumstances. So it might be what happens during a recession, what happens if interest rates go through the roof, all kinds of things like that. Now, management. Management, it has one of the biggest impacts on the future success or destruction of a business. Now, the things that we want to look out for are they candid, open and honest? Are they aligned with those shareholders for the long term? They're not just trying to bump the price up short term. And are they rational with how they allocate the business's resources, which could be its people, it could be where it's focusing its strategy and the people and the money on. And we want to make sure that they're using it effectively. What about this target? So we can see in the middle of the target, the more accurate we are, the closer we are to the middle of the target, and that's for its lower risk. Now, if we're completely off with our assessment, it's high risk. And that would be when we don't know what we're investing in. We wouldn't even hit the target. We'd be completely off. So how do we increase our accuracy? So we want to be in mastery. And so competency. So do I actually understand this business, the sector? Do I understand what the customer actually wants? Warren Buffett refers to this as being within his circle of competence. And if he doesn't understand it, doesn't buy it. Because how can you understand a business and make this assessment if you have no idea about it? And that's when we said it's high risk if you don't. So the next is consistency. We want to make sure the business is consistent. If something is inconsistent, it's very hard to see and make an assessment about where it'll be in the future. And continuity. Is the actual business continuing relatively unchanged? So are they still providing the same products and services? Is the industry going through some significant change or challenges? things like that. We want to make sure it's continuing relatively unchanged. And that's how we can be more certain where it'll be in the future. Now, how do we reduce risk? So we bring our discount back into it, our margin of safety. Now, we have to be able to come up with a value for the business, and then we want to come up with that discount. And between those two, that's where we come up with our buy price. And so what does that look like? Well, our arrow is the value, and the discount gives us that margin of safety, or in this instance, a margin of error. Now, if we have a guess for the value and it's in a business that we don't understand, it's inconsistent, and it's changing its business strategy all over the shop, there's no competitive advantage of the business, and management are literally just destroying the business, we're going to be throwing arrows all over the shop. And even with a giant margin of safety, we still will be high risk. Now, that margin of safety, like I mentioned, can make a terrible business an incredible investment. Depends, it needs to be at the right price. Now we can see that the gap between value and price is the strongest way to reduce risk. And that's as that stock price goes up and down over time, it crisscrosses between being overvalued and undervalued. The only thing is those opportunities don't come up every day. So let's visualize that. We've got our margin of safety where the market is mostly efficient. There's opportunities that come up every now and then, and it's a door of opportunity. And so that means that we must be patient if we want to be able to hit that target and find these low risk investments. Now, these investors are apex predators. And the best apex predator is one that you never see coming. Think of a lion, a great white, peregrine falcon, the like. Now, these investors, in human terms, are like a sniper. They're waiting patiently. They're monitoring conditions and the target. And they wait for the perfect opportunity before taking their shot. If you want to create generational wealth, you do not need to be a genius. You need a repeatable way to think. And here's the recap. Risk is not volatility. Risk is permanent loss of our money. And permanent loss comes from two big risks: buying something you don't understand and paying too much. And the game is we need to find stocks that are worth hunting, only buy when we understand, wait patiently until that door of opportunity opens, and then when you strike, buy with a margin of safety. Now, if you apply this framework consistently, you'll stop chasing returns like a dog chases its tail, and those returns will start coming to you. Now, if you got value out of this, please give it a like. It helps get other long-term investors to see this. And subscribe if you want to learn about more tactical investing tutorials just like this without the fluff. Now that you know the risks to look out for when assessing individual stocks, you need to watch this next video. It's where I break down the 5-step process that these legendary investors use to find all the way up to managing their own portfolio. So check it out. Cheers. Get after it.